Well, having focused on finance and geopolitics this morning, we are changing the perspective to move downstream. This next panel is the future prospects for global downstream profitability. And moderating is Tom Wallin, Editor-in-Chief and Executive Vice President of Energy Intelligence. Tom.
Thank you very much, Peter. Good afternoon, everyone. In this session, we'll be looking closely at the downstream refining and marketing segment of the oil industry and its future profitability. While traditionally this sector does not earn the kinds of profits that are achieved by exploration and production activities, it has proved something of a lifesaver to integrated oil companies in the last couple of years, providing a solid return that cushions the relatively poor upstream profitability. Nevertheless, there's no denying that over the years, the refining and marketing business has suffered from numerous long periods of poor profits and overcapacity, a condition that's sometimes been considered to be the norm, actually. Some integrated companies have opted to divest their downstream assets and simply focus on the upstream. And at the same time, we've seen the growth of pure refining companies who are kind of true downstream specialists. Regardless of this ebb and flow, the downstream merits the downstream merits our close attention because of its critical importance for the entire industry. I think it's very important to remember that a barrel of crude oil is worth little or nothing in and of itself. A barrel of crude oil only has value in terms of the refined products that can be created from it. So all of our talk in the last couple of days about crude oil at $100 or $20 or $50, that all is very much founded in the downstream refining and marketing part of the business. With us today to discuss the outlook for the downstream, we have three very different and very well-informed perspectives. To my far right is Roger Brown, who's the CEO of European independent refiner Varo Energy, and next to him is Dawood Nassif, who's a board director of Bahrain Petroleum Company, a state-owned refining company in the Middle East. And to my immediate right is Malcolm Turner, who is the founder and chairman of Turner Mason, a downstream consulting firm based in Dallas, Texas. So I'm just going to kick off with a question for all three of you. The refining sector has actually been relatively profitable for extended periods in the last 10 years. And some have even called this a period, kind of a golden age of refining. What are the prospects of this trend continuing? And are we approaching a cyclical downturn? And which regions are most at risk? So, Roger, why don't you start off and then we can work our way across.
Sure. I guess I'd have difficulty calling it the golden age. I've got some relatively pleasant memories from about 2006, 2008 kind of time. I guess I was in Russia at the time and refining was a great business there all the time. But since then, I think we've had a couple of what I call maybe relatively good years, including last year, 2015. But we've also seen about 4 million barrels a day of refining capacity shut down and removed from the market. So I wouldn't classify it as particularly a golden age from that respect, certainly from their respect. But on the other side, I think we've seen a great increase in demand during that time. So more than 1.2, 1.3 million barrels a day globally of increased demand, which has been good to see. And about 7 million barrels a day of new capacity coming on. So I think certainly the investors in that new refinery are optimistic about the future of refining, and I guess I'd have to say I'm optimistic with them. So overall, I think what we've seen in the last decade or so is a rebalancing of refining supply-demand capacity globally. We've seen a lot of inefficient refineries moving out, some new, more efficient ones coming in, and demand growing. And I think we're coming to the end of that process now. I think there's still probably another 1 million barrels a day to go out. Some of it's already been identified in the UK, France, Japan. But I think overall, as demand grows through 17 and into 18, we get to a much more globally balanced refining space. And I think we'll move back to a much more kind of a mid-cycle range from there on out, with some new refineries coming on, but still demand growing at 1.1, 1.2 million barrels a day. and keeping things fairly balanced from there on. And I'd expect us to come back more to a mid-cycle kind of space, I think, from there out. But having said that, I think you can't ignore the fact that the inventories at the moment are incredibly high. Overproduction of crude oil has forced up crude oil stocks by, I think, 400 million barrels or something. And then crude producers have priced oil into the refineries to encourage us to run, which we've been happy to do. And we've filled up our own inventory. And now product inventories are at very high levels globally. And the big question, I think, immediate question for refiners is, what are we going to do with what's going to happen to that inventory? And where's it going to go? And when's it going to come back out? I think demand will do its piece in that. We're going to see an increase in demand, and that will maybe take some of those barrels. But it's really going to take refinery run cuts to eat into that inventory, I think. And refinery run cuts will only be driven if we see crude tightening. And we've had a lot of conversation in the last day or so about the crude markets, and I'm relatively bullish from what I could tell. So I'm sure we will see that at some stage. I'm certainly not seeing it at the moment. I think we're still seeing discounts and being encouraged to run, but at some stage it'll get tighter. And when that happens, we will see run cuts, and we'll see a very painful time in the refining sector, as we have to cut runs and inventories have to be depleted. So I think there's light at the end of the tunnel, 18 months out maybe, but it's going to be a very bumpy road to get there, and we won't. Some people won't survive it.
And is that particularly sort of from sort of as a perspective of a European refiner, or you think just refining globally is it?
I think refining globally will see the bumpy ride. I think certainly some of the weaker refineries are still in Europe. I still put Japan in there as well for future closures. And I think the kettles in China are going to come under a lot of pressure as well, but internally. So I think we'll see those reducing as well. But certainly Europe has a big problem with distillate inventory at the moment, and we're going to have to do some pain to get through that.
So, Dawood, what do you think? What's your perspective on future profitability?
I cannot disagree much with what Roger just said. And refining business has always been a challenging business. And I wouldn't term it a golden age. It's been good years, but challenges lie ahead, and challenges will always be in the refining business. And depending where you are and what sort of refinery you're running, Europe and Japan are going to be most affected by any downturns because this economics of scale, size of the refineries, and the process configurations, which is challenging, and also the type of products they're making, which it might not be the products that the market wants at the moment. Refining, there's some people who can make in refining money all the time. Some can make it sometime, and some are mostly on the losing end. Fundamentally, you got to have the right process configuration and a low operating cost to make it profitable, and the economics of scale. The 100 to 200,000 refinery, which used to be good size or large size in the past, today is either small or medium size. 400,000 is about the size you want today with the right process configuration. Refining mostly is going to be moving to either Middle East or the Far East. These are the two world centers where it's going to be. North America has been enjoying some honeymoon at this period because of certain market dynamics. And some of the refineries which were scheduled for closure, they survived this period. It might go on for a while, but I don't think the honeymoon will carry on forever, and reality will catch up with them. Operating costs is another challenge in this business. You have to keep it down to make sure your margins are protected. Gasoline, diesel mix, is it a boy, is it a girl? Is it gasoline or is it diesel? Diesel has been much in demand, particularly in Europe in the recent past. Gasoline is coming back. The change in the marine diesel spec will affect the market, and what is going to be done about it if the IMO specs come into 2020 as expected now. This will have a big impact on the fuel oil quality, and what would be marine diesel like? Is marine fuel like? Diesel going to be the marine of the future? Time will tell, but it's moving that way. This means more demand of diesel will come in, even if gasoline comes back into cars. However, electric cars are also coming in. They'll probably eat away from the gasoline market. Still small, but will grow over time. The two areas to stay profitable in this business, but you have to invest, are two areas you want to stay out of: fuel oil and naphtha. Fuel oil always trades below the price of crude. This means every barrel of fuel oil that leaves your refinery is at a loss. Naphtha trades sometimes above, sometimes below crude, so it varies. When you upgrade it to petrochemicals, you add value, you make money. The solution is you got to have an integrated company, upstream, refining, petrochemicals. The cycles don't run at the same time, but one will help the other one when one of them is at the down and the other one is at the peak. Integrated refining petrochemical is certainly very, very much what most people have seen and still seeing and doing. And if you have an upstream arm as well, that completes the whole picture. So, challenging market for refining, money can and will be done. You have to have the right process configuration, watch for the specs coming, especially the fuel oil specs and IMO, and make sure you have a low operating cost.
Good, thank you. Malcolm, what do you think?
Well, I want to mention that I've been wrong a few times. I used to think that, well, I wear boots, and you'd think from your common sense that if the price of leather goes down, the price of boots will come down with it. And I took that analogy to think that lower prices of crude oil would make refiners, which you can't drink it, as you pointed out, you have to put it in a refinery. So lower prices of crude oil, it stands to reason, would make refiners more money. That's just not so, and I finally learned that lesson and criticized another consultant who had a function of whatever that showed what the price would be, the margin would be. But the truth is, the data show that the higher the price of crude, the higher the margin for the refiners. So now we've enjoyed some golden age and some prosperity over a period of time, but it's been surprising to me to learn that overall, the higher price of crude oil leaves a bigger range for our margin. Now, I'd like to address a point you made about size. I haven't experienced that. Now, the United States has any number of sizes, and generally smaller sizes have failed, but the truth is, I've seen a lot of small refiners, and I'm looking at one right now that's 10 or 15,000 barrels a day. And you know, they drive big cars and make a lot of money. So the size of the refinery doesn't necessarily dictate the profitability of the margin. And I've observed that too. But I especially want to emphasize that the correlations between prices of crude and prices and margins for refiners vary all over the map. Now, we did pretty well for a while, and even last year made money with lower priced crude. But it's just not true that lower priced crude means higher margins. And the correlations for that just don't work. And I have an excellent staff that analyzes all of this stuff, and I used to really strongly believe that, but that's just not true. While I'm talking about correlating and everything, we operate a lot off of models. We build models for the refineries. And one thing that you're told to do, it's holy, absolutely holy, to validate the model. That is, it must predict history. So you build your model for your refinery. I used to do very complicated models with theoretical derivations of yields and stuff like that. You don't do that. You force the model, you force fit the model to produce history. And one of the things that I do want to mention is the climate change models don't fit history. They're not validated. And so we're getting told alarming stories by a wide variety of folks that we're going to have climate. Well, of course the climate changes. We all know that it does. And we do know and admit that the emissions has something to do with it. But it's not as indicated by the alarmist at all, because the data don't support their models at all. They've been quite wrong. And backcasting, we call it backcasting, you backcast and calculate what happened, and if you never do get it right, that means your model's wrong. And that's true in refining. So I say that I've had a hard time forecasting, for example, in Europe, I spent a lot of time working on that Milford Haven refinery. And you know, that thing still was making money at the end. And it turned out that Murphy sold it or dismantled it. It's very difficult to forecast. What I've learned, and you'll agree, management. That's the key. And I think it can take any size refinery with good management, good technical skills, and good yields, and reduce operating costs and make money.
I think that's a very good point. It's very difficult to predict which refineries are going to fail. Everyone has a list, and it's always wrong.
It's always wrong.
It's always wrong,
Yes.
and it's because it's. I don't think it's about size. I have a 70,000 barrel a day refinery. It makes a lot of money. Thank you. It's about management and about technical understanding and commercial understanding of how to run a refinery, having access to global crudes as well, so you can pick the right crudes for your refinery and find those distressed cargoes out there. So I think you can do a lot with management. I think having a big refinery with a big chemical complex is a great starting point.
It is.
And it's got to be the best place to start, but I don't think you can necessarily say it's the small refiners at the end of the day that are going to fail. I think if you manage them well, and because they're far more adaptable at the end of the day, you can be successful.
Okay, well, I wanted to ask a question about refined product trade. We've seen a pretty significant growth in refined products exports from places like the US, India, Saudi Arabia, even China. And I'm just wondering how sustainable that kind of growth is, and also what the implications are for oil markets. I mean, if we go to a world with this kind of volume of product trade as normal.
Well, let me just say about U.S. refineries are superior. They're really much better configured than typical refineries in other parts of the world, and their operating costs have a huge advantage with natural gas as the fuel stock. And I didn't appreciate how much that matters. But you take the St. Croix Refinery, which is an island refinery. I don't know if John Hess is here or not, but we've worked on that thing forever and ever. Can't make it because, as a refinery, because it takes crude oil and uses that to make fuel for its needs to make steam and so on and so forth. And in the United States, we have the advantage of very low cost natural gas, and therefore with good management and good technical training, we have good survival rates and good profitability.
And so that's going to keep an edge for U.S. exports or for refined products, in your view? Is that
our
conclusion?
Our ability to export refined products is quite proven to be far better than I expected. Yes, I think that we will continue to export to virtually all of the South American countries and to the Asian countries as well, because we can make them cheaper. Now, I don't believe that price level has been reached, because that is the very minimum. We're not competing entirely, but when we do have to compete, we'll win, because we do have lower cost operations. I hope you agree with that.
I think, Dawood, you have a different view,
operations.
don't you? You have a somewhat different view?
Well, refining, of course, it's area specific. The most modern refineries, mostly in the Far East and the Middle East, that are most integrated and high conversion refineries. U.S. refineries, few of them, some of the ones owned by ExxonMobil and Chevron, have a lot of conversion capacity, but the majority don't have all the resid hydrocrackers and the resid FCCs, and that you will need a lot of cokers around, by which you produce a lot of coke for different reasons. But the Far Eastern refineries are very well integrated refineries, and their cost base is low. If you look at the Solomon surveys, they'll always come high, either quartile 1 or 2, majority of them. But again, it's site specific, you cannot generalize. Some European refineries still come in quartile 1 and 2. So, but the majority don't in this area. Keeping cost per barrel down is critical to your marketing and to your margins, and Far Eastern refineries probably come on top there, okay? Middle Eastern refineries, of course, all the new ones that come in Saudi Arabia, they're all high conversion refineries, well-integrated refineries. A lot of them attached to a petrochemical complex. And their cost is low, their crude cost is low. So by definition, they're going to compete and sell products to Europe and the Far East and Africa, etc. So they will have an edge. So size, when I mentioned earlier, that was for an export refinery. If you're selling internally the products, you have a coveted market, it's different. But if you're competing in the export market, you need to have that scale to be able to compete effectively with it. Products will continue to move. I mean, we've sold products as far away from right in the Gulf all the way down to Venezuela and to Argentina. So there is no rule really, depending on the price, the freight cost, and if the cargo is viable to be taken as far as that, so be it. Again, the fundamentals are there. You're going to have the right feedstock, right process configuration, low operating cost to be able to compete in the business today. It's reality.
Well, it sounds like we have a very competitive market here then
Absolutely.
for exports. I mean,
It will always will be.
Do you agree with that, Roger? Is that how you see it?
Yeah. I mean, I'd agree with Malcolm. I think the US, the crude producers will price oil into the refining system in the US and keep them running at very high utilizations, and we'll still see distillate exports coming out of the US, particularly into South America, I think more, and some still into Europe. If you look at the other exporters out there, I think India, local demand is growing so fast that I think if anything, you're going to see reduced exports out of India. Certainly they'll still be there, and I think they'll still flow into Asia to some degree. But local demand is growing at a pace, and you'll see less coming out of there. As I said, I think the kettles in China have got a limited, I think they'll be around, but to a less extent, so you'll see less coming out of China. And I think actually the Middle East, I think you're right, is going to be the interesting one to watch. It's going to, where are the Middle Eastern barrels going to go? They will find their homes. That'll either be in Asia or Europe, and to some extent into Africa. But that swing between whether they go to Europe or they go into Asia is going to be an interesting one to watch going forward. But
does the removal of the U.S. export restrictions on crude oil affect the ability of
U.S.
refiners to...
Unfortunately for the U.S. refiners, it means they'll never see the fantastic margins they saw when Brent TI blew out to crazy numbers. So we won't see that again. But I still think that the crude producers in the U.S. will price oil into the U.S. refining system to cause them to run that product and therefore continue the exports of distillate, albeit at lower margins.
Right.
I don't think it's well understood that you point out you can't drink crude oil, so you have to put it in a refinery, but do you realize they don't have anything to do with the price in the United States, at least. They pay what they find out what they paid later the next month, but they don't get to choose the price of the crude oil. Now, you do choose by your configuration whether you run a heavy sour or you run light sweet. But the price that you pay, you find out later. And then similarly with the products. You sell your products, your traders sell your products. The refinery people, the technical people don't have anything to do with that. And so they get the margin that they get. They don't get the margin that they seek. So the thing they can do is they control operating costs. We've agreed on that. And I think that I've observed higher operating costs with larger facilities and lower operating costs with smaller facilities. It varies more by management and by company than it does by size. So operating costs is a controlling factor, and of course capital is. How much capital you spend on your facility to put in cracking or coking or hydroskimming or whatever kind of facilities. And that situation varies totally with the location and with the company.
Okay, I wanted to pick up on, Dawood mentioned the diesel as being an issue, and I wanted to talk a little bit about diesel in particular. It has been a kind of a star performer in the recent past, but the question is that star now fading? I mean, we've got Asian demand, there are new capacity additions, you've got this VW emissions scandal. And then you also brought up the whole question of the role of bunker in the bunker markets, the role of diesel as a bunker fuel if they change the regulations on bunker fuels. So who wants to take that? You want to start that?
Sure.
Yeah.
I think there's going to be a home for both gasoline and diesel, frankly.
A whole what?
A home.
A home.
Yes. They'll both do well at various levels, and one will do better at times, the other one will do okay. Gasoline is mainly for private cars, for cars. Diesel is, apart from cars mainly in Europe, also for heavy trucks and machinery. And if diesel goes into marine as well, for bunkering, that's another dimension. So diesel is going to be in demand, for the foreseeable future. And gasoline will coming more as more gas in the U.S. is driving more because the cost is low now. You can see people are back into even larger cars and driving more. So gasoline consumption has gone up. Now, electric cars, I think, have currently minimalistic impact. It's very small. Might grow until they get all these systems properly put down and the charging of these cars properly done, and all this is going to take a while. So gasoline will be there in demand as well. I see a market for both growing for the foreseeable future.
Well, it depend a lot on the tax structure of the local area, and it does, because I understand that Europe is reducing its diesel tax and shifting demand toward gasoline instead of just relying on diesel. Of course, refiners can make either, and we can make the specifications, and the cost is negligibly different, but the market that it goes to is more local and directed. And you're right that it's automobiles are more gasoline driven around the world, and certainly in the United States, and diesel is more truck driven, and that's the way it's going to be, because that's the kind of engines that we have. As far as electric cars, let me just say this. Some of you may have heard what Bryce Mulder said at the AFPM. He said electric cars are the car of the future, and they always will be. So you may not believe that here in Europe, but I do.
In the US.
I don't see a lot of people driving electric cars, at least during our lifetime.
Do you share that view about electric vehicles?
I think let me come back to
Switzerland,
that. Get to the first point. Yeah, maybe in Switzerland. I think to get back to your first comment, I think the distillate gasoline piece, I agree with Dawood. I think what we're going to see is we're going to move from a very much a distillate driven refinery margin market, which it certainly has been over the last few years, and we've seen investment in refineries therefore mainly going towards cokers and hydrocrackers to meet that demand. But I think what we're seeing now is much more of a structural increase in gasoline demand. And that's driven, as you said, by regulatory changes in Europe, pushing people from diesel into gasoline, but also by massive growth in the gasoline markets in India and in Asia, and to a lesser extent in Africa. And I think that'll change the global balances. And I think what you're going to get is a margin that's driven much more by the two on a combined way. And I think what will be interesting in that is I think the gasoline demand we saw last year, I think everyone was surprised by how far the refineries could shift their yields over to gasoline to meet that demand for gasoline. But if you start to add distillate demand in there as well, then you don't have that flexibility to shift yields so far. And so I think refiners are going to have an interesting time balancing between distillate and gasoline demand as we see it leveling out. And so I think you'll see a lot of volatility in diesel and gasoline cracks against each other and varying regionally, which is going to be an interesting place to be. On the electric cars, I guess I think pure electric. I think they're too expensive. The infrastructure is just not there at the moment, even in OECD. And also the resale value is terrible. So it's because they can't resell them anywhere else, and because of a battery life issue, I think. So there's a lot of technologies that still go in that space. I think hybrids we will see starting to come into the market more, and I think even again I think it'll be a minor market penetration probably for the next 5 or 6 years, and then I think you'll start to see the car fleet starting to change over. And I think it takes about 15, 20 years to change fleet anything sustainably. So you're really talking 15, 20 years out before we see something that has a real effect on us, a growing effect over that period. Which I think the US will see that first because it's such a gasoline-orientated market. And then we'll see the refineries having to rebalance. Against that, I would say we will see chemical demand growing during that time. So the light ends are, we're heading more into the naphtha streams maybe, and we'll see more demand in that space.
Well, your point about bunker fuel is extremely important and not well known. You mentioned correctly that in 2020 it seems highly likely now that specification is going to drop from 3.5% down to 0.5%. Where do you get that stuff? And if your refinery doesn't have a coker, and if you're running heavy sour crude, you've got a problem. You've got to do something with that stuff. And if you otherwise you put diesel in it, or fuel like that, or LNG, but I think that's a very unknown, unstudied problem that is facing refiners. What to do with the bunker fuel?
I think we find out next week whether it's 2020 or 2025 from Marpol. So we'll keep our fingers crossed for 2020 as a refiner anyway.
Well, it's 2020. Most refiners cannot react that quickly if they're not ready for it.
And they're not.
It's not going to happen. So people who are ready for it are going to
do well
in this period, and the others will struggle.
Well, I was in the asphalt business for a long period of time, and that's a great place, but there's just a very small amount of that you can put on roads and use. So if you have that yield from a heavy sour crude, you've got to figure out something to do with it. You can't export it.
It'll be interesting to see what the shipping market does. So I think there's plenty of demand coming on for distillate generally. So aviation fuel demand is growing enormously globally. Right. We're seeing general non-light vehicle growth in diesel, so transport markets and agricultural markets all growing globally as well.
Yep.
So, I mean, distillates are going to be a strong product going forward one way or the other, and if the Marpol thing goes in 2020 and we start to see marine demand as well, then that's only going to make it stronger. But what I think that'll do is it'll drive the diff between fuel oil and diesel to the point where shippers will have to start investing in scrubbers. And at the moment, we're just not seeing that from what I can see. I think new builds are having scrubbers, and I'm being told that as they come in for refits, then people are fitting, but they're talking $2-3 million in a shipping market that is probably at the worst it's ever been. So I don't think too many people are investing today. So I think you'll certainly have an increase in demand for a period of time. Then I would expect the diff to drive shippers to invest in scrubbers over time, and we're seeing it level back out again to more a fuel oil coming back slowly, but it'll take time to get there.
So you could have a big pull on diesel even despite this VW emissions thing you don't think is a non-event? Is that just like...
Light vehicle diesel is only really a European thing. Outside of Europe, I think Korea and Europe are the only two that really have a light vehicle diesel market, and otherwise it's all I think, even in Europe I think it's 70% is commercial diesel, so it's
okay.
quite small.
I had some questions for each of you individually. I just wanted to throw out there before we open it up to the floor here. Roger, Varo Energy is one of the few European manifestations of the sort of independent refiner business model, and it's something that's much more common. We see more commonly in the U.S. And I just wondered if you could tell us a little bit about what you think it takes to succeed as an independent refiner. What are the, how do you make that work?
We're trying to figure it out.
Next.
Next. If anyone has the answer, let me know. Well, first, I don't think we're the only one by any means. I mean, we'd be doing a disservice to Ineos and Gunvor and Saras and Motor Oil, and there's a bunch of other people out there as well. I think what we've seen over the last few years is the majors really looking at rebalancing their balance sheets towards more long-term, high capital intensive upstream businesses. I mean, Bob Dudley yesterday talked about the competition for capital from the majors' capital globally in the upstream, but there's equally a lot of competition inside the majors between upstream and downstream to get that capital. And from my days in BP, I remember it well, and I remember generally downstream used to lose. And so they've kind of taken that, and I think they've divested pretty dramatically across their refining and midstream base. to a few core refineries that they still maintain. And that's right, has basically let in the independents and particularly ones associated with trading houses such as we are with Vitol into that space. And that's really what's driven it here. What does it take to succeed? So I always tell people there's four things, so I'll tell you the same. I think you have to have access to global crudes, the most important piece.
To what?
So to the global crude oil market. So you have to have a first-class global crude oil trading team, which we're lucky to have because we have a partnership with Vitol as our parent. So I have the Vitol crude team, which I think is probably one of the best in the world, who are scouring, and we were the first to bring a US cargo actually out of the US. And that's what you have to be. You have to be in the market, finding the distressed cargoes, finding the cheap cargoes that are always out there somewhere, but also finding the crudes that fit your refineries for the markets you're in and the way your markets are pricing at the time. So that's the first one. Second one is financial strength, and really financial strength to not only cover your capex charges as they come through, but also derivatives. I think to survive as an independent refiner, you have to have a very healthy risk management hedge book. So one of the issues of a downstream business, any downstream business, is holding stock. But in the contango market, that's a great thing to have. It's a nice problem to have, as long as you have the facilities to actually place paper and hedge that stock going forward in the contango market. You create value from it, and we have some of our inventory hedged out to 2020 now, which is a fantastic baseline for us in terms of income. And then lastly, for hedging refinery margins. I mean, I think in this volatile period we're seeing, the ability to hedge margins further out when you see anything that's half reasonable to lock in some cash flow for the smaller independents is very important. So that's my second thing. And my third thing would be high, safe and efficient operations and running at very high availability. As independents, you can't afford to have downtime. And I think a culture of almost obsessive optimization of how you run your kit. We build teams. I mean, we talk about being low cost. I think low cost in maintenance, low cost in energy, absolutely right. But what we've built a lot of things is putting money into people who look at how we optimize our refineries, how we build our LP models, bring them up to date, running them, testing them, and just optimizing and re-optimizing the way we run our refineries every day. And making some investments to increase optionality, which the majors never did because the battle was always won by upstream for the money. So we have a lot of projects that pay back in 18 months, and so that's important. And the last one is to have a complete fuels value chain. So you have a refinery, you have midstream, and you have marketing and sales. And by controlling that fuels value chain, you can become super efficient by loading up that system and balancing it so that you are the most efficient and most competitive supplier in the regions, particularly around your refineries, so you can protect your margin and keep your competition out.
Okay, good, thanks. Staying with the topic of sort of the business model and what kind of structure, company structure works. Malcolm, I wanted to ask you about integration, the vertical integrated model, the sort of classic, vertical integrated oil company. Has that come back into fashion now in the last couple of years? I mean, we've seen with the ability of the downstream to basically help out the upstream, or is that, what is your view on that?
Well, I'm glad you asked, because since I was a small boy, I've tried to convert producers, and this is a producer conference, by the way, E&P. It's not a refiner conference. We're the only refiners here, I think. But
this is it.
I've tried to convince producers to become refiners and become integrated. Never have I succeeded. Scott Sheffield was here the other day. I've tried and worked in. And the opposite. If you tried to convert a refiner into a producer, that's impossible as well. They're just like this, and they won't know is the answer. There's not going to be any vertical integration. Now, Rex Tillerson said something about the advantages this morning.
He's singing the praises of it.
He believes in it. Mm-hmm. He believes in it. But he's a huge, he's ExxonMobil. Most companies don't think that way, and it's not going to happen.
Okay. And Dawood, just before we go to questions, one quick question for you. All this growth in product exports from the Middle East, how do you see that changing the market? Is it, especially since, Bahrain Petroleum has been there doing this for so long? Do you have a particular view on that?
Well, the market is growing. All the markets
demand is growing.
Are growing. I mean, and will continue to grow. We all want to fly a plane, we all want to drive a car, we want your goods to be transported by trucks. And there's more and more of it. So we see growth, we see opportunity. That's why we're investing heavily. Big investments both in the refinery and the petrochemical complex integrated with it. We believe the market is there, but you have to control your operating cost. Make sure you have the right feedstock and the right process configuration to help you out deliver what you're looking for.
Okay, thanks. Well, let's see.
And before I finish,
go ahead.
one challenge for the whole industry is people. Experienced people. There's a gap of about 10 years which we lost, by which we didn't bring people in. People stopped going to university to study engineering, the disciplines we want. We have that gap with the whole generation retiring, and then you have that vacuum for 5 to 10 years until you get the next one ready for it. So this is the biggest challenge we're facing, and many others like us are facing now.
Right.
Absolutely.
I was talking to the young man sitting next to me at lunch, and he's a petroleum engineer. I advised him to stay in petroleum engineering. My grandson's a petroleum engineer. Don't go into refining. And because just the complexities and the problems, although there is a demand. You're exactly right. There's a gap.
Well,
people talk about technology as well in upstream. I mean, the technology advances in downstream have been huge as well. I mean, in terms of looking at refineries and how they're designed, the metallurgy, the catalysts, the way we run refineries today has changed dramatically. And we talked about digital data analysis and stuff. I mean, we have sensors everywhere. We have measurement systems looking at those data and optimizing the refinery on a minute-by-minute basis. So it's a fascinating market to work in. That's as an engineer. I'm an engineer myself, but it is. You're absolutely right. There is a hole in terms of having people coming into the industry.
Okay, thanks. Well, we have time for, I think, like one question here. And, right here.
Your crude oil supply, are there changes to that? Do you see lighter crudes, more condensates available, more LPG that goes directly to customers? How does that change your operation?
So how do you see the crude oil supply changing in terms of lighter crudes and condensates? Is that correct?
Yeah. So we're certainly seeing more lighter condensates around because of gas and shale and coming out of the US now. There's a lot more light product coming through. The problem is running it. A CDU can only take so much light end product, and you start to fill that up, you lose the bottom ends, which is where a lot of the value is. So we're running a lot more condensate now, but we're having to blend it with much heavier grades to go with it. And it's getting, as I said, it's getting down to getting the right availability of crudes from the market. So the condensates are very cheap. And certainly some of the ones we bought in the US have been cheap, but we have to buy heavy crudes to go with them to enable us to blend it, and that's where you need this global coverage of crude oils.
Yeah.
Well, I'm afraid that's all we have time for, so I'd like to ask you to join me in thanking our panel and turn it over to Peter.